Okay, I think it's just us still. There we
I'm
go.
not, okay, people are starting.
Yep. So good morning, everyone. Welcome to Business Income and How It's Taxed. I just opened it up, so we'll be having everyone join us. This is presented, of course, by the Maricopa SBDC and Tanya Luken, and we will be recording this. So it will be available on our website as well as the state offices, the Arizona Network YouTube channel. And we just wanted to let you all know that this is just generic information. It should not be used as specific tax information. The format for our webinar is going to be Tanya Luken presenting. And then if you do have any questions that you would like Tanya to answer, there should be a Q&A option at the bottom of your screen. If you could just go ahead and type in those questions, Tanya will be able to see those and we'll answer them when she has a break, or if it's something that applies to what she's speaking about, she'll go ahead and answer those. And then at the end of the presentation, I'm going to go ahead and launch a poll just to get your feedback on the material. And right now, this is the only format we're able to do, obviously, in our virtual environment. So why don't we go ahead and get started. Paula Whittakin is one of our business analysts, and she's going to do a short introduction on the Maricopa SBDC.
All right, thank you, Donna. Good morning, everyone. We're glad you can join us for this webinar for business income and how it's taxed. I'm sure you're going to find all the information that Tanya provides with us for us today just really, really valuable. She's great. She puts it in a format that is not intimidating, and I don't know about anyone else, but when I hear this business income and how it's taxed, I want to run the other direction. But Tanya's going to take us through it in a very easy way to understand it and help you in your business. So before I turn it over to Tanya, for those who might be new to the Small Business Development Center, I just wanted to overview our services. Mainly what we provide is no-fee counseling to businesses, really anywhere along that life cycle. Maybe you've got a business idea and really don't quite know how to move forward with that. Maybe you've opened for business, so you're kind of in that start mode and you're trying to get some traction and figure out how to grow. Maybe you're scaling up, or even those established businesses that are working to grow. And we help small businesses across that range. We also provide training such as this, and also have some great research tools to help our small businesses. Now, we're able to provide this no-fee counseling because we are funded here locally by Maricopa Community Colleges and also by the Small Business Administration at the federal level. We have, I think over 15 counselors now, and we're spread across Maricopa County. So we are all, of course, working virtually now, but as things return to normal, you will find us typically at the Maricopa Community College campuses across the county, and then we also have presence out at the city of Peoria. Now, some of the areas that we're focusing on and help our clients with, especially at this time, we've been helping them navigate through the disaster loan programs, figuring out how to get access to some of the funding. As we're trying to move into recovery and figuring out, how to build these resilient businesses. We're helping our clients with a financial review, doing some resiliency assessment, helping them, as they're looking perhaps for additional funding, helping them to get lender ready and determining how ready they are to approach a lender for some additional funding. We also help in many different areas not shown here: sales, marketing strategy, growth strategies, all of those different areas. But we also have experts in export and international trade, manufacturing, and also the PTAC group, the Procurement Technical Assistance Centers, are experts in all things government contracting. So you can find us at maricopa-sbdc.com. And just very quickly, if you're interested in counseling, just go to our homepage and look for the Request Counseling link. And that will take you through a very simple form to follow, and that puts you into the system, and we'll reach out to you and start you on the path to our no-fee counseling. And with that, I'm going to turn it over to Tanya. And Tanya, take us through this business income and how it's taxed topic.
I'd love to. Thank you, Paula. Okay, let me get situated here. I know it's a pretty attractive like black screen there, right? So we'll get back to the start. Good morning, everybody. My name is Tanya Luken, and I'm a CPA, and I've owned a small business. It was 20 years in May, so that was pretty exciting for me to hit a 20-year mark. I've been helping small businesses with their accounting and payroll and just kind of like consulting needs. And we specialize typically, bars, restaurants, nonprofits, and rights management, which is royalty accounting. Today, I'm actually talking to you from Portland, Oregon. I've been up here. I've been a snowbird this year. And it's very smoky today, so you're going to hear me harumph a lot and like have to stop to take drinks of water because the air quality here is terrible today. But and remember, put your questions in the Q&A. I'm happy to answer them as we go. I know this is kind of a strange format, but I'll answer. We have time for questions, so please ask them. Okay, so just a little disclaimer. The purpose of this presentation is just to enhance your knowledge of tax matters. It's not necessarily designed for specific advice. So make sure that if you do have a very specific question, you're welcome to ask me. And if I can't answer it specifically, then I'll let you know. But this presentation is for educational purposes. So the first thing I want to talk about today is the different types of business entities. So the basic types that you have, there's a sole proprietor, a partnership, an LLC, an S-CORP, or a C-CORP. So some of these require paperwork. Some of these require a little bit of formation process. Some of them, most of them you could do yourself. Some of them people do with lawyers, but we're going to talk about each one in a little bit of detail because depending on which one of these 5 you are, determines how you pay income tax on the profit or the profits from your business. So the first one we want to talk about is a sole proprietor. So the advantages, it's very easy to form. So for example, if I wanted to start a dog walking business, and I have a dog with me today, so you'll probably hear her at some point with a squeaky toy or yelling at the mailman. But so if I wanted to start a dog walking business, I could say, hey, it's Thursday and I'm gonna own a dog walking business. And all of a sudden, like me just saying that either to myself or to someone else makes me a sole proprietor. So that's it. It's so easy to form because you have to do nothing to form it, basically. There is no separate income tax form. So you just file, you add a page or 2 or 4 onto your regular 1040 form, and there's total ownership rights. So I would own 100% of my dog walking business. The disadvantages is there's unlimited owner liability. So let's say that I'm a terrible dog walker and I walk a dog in front of a city bus. The owner could sue me for, the vet bills and things for that dog. And if I had no money, in theory, I would still be liable for, I could lose my personal assets to settle that claim with the owner. It terminates with the death of the owner. So if I were to get run over by said city bus, then my business would be at its end. And it's subject to self-employment tax, which we're going to talk about in detail. But roughly what self-employment tax is, how if you've had a paycheck in your life and you have Medicare and Social Security come out of your paycheck, when you're self-employed, there's no paycheck. So you don't have any Medicare and Social Security coming out. So you have to pay that on your tax return, on your regular 1040 form. So it's roughly 8% of whatever your taxable income is. Okay, a partnership is its advantages. It's a separate entity from its owner. So it's separate from me saying, it's different than my dog walking business. It's easy to form. Again, you just find at least one other person. So then there would be at least 2 people. And you would say, hey, we're going to form a dog walking business together. So like Paula and I could form a dog walking business together. So the management risk is shared by the partners, and I could sell my ownership, or Paula could sell her ownership. We could sell it to each other, or one of us could sell it to Donna or to Connie. The disadvantages It's unlimited liability for the general partners. So again, it's that same kind of, my personal assets aren't as protected. In that instance, the earnings are subject to self-employment tax. So there's no Medicare and Social Security coming out of a paycheck. And you have to file a separate tax form. So partnerships file what's called a 1065 every year. And it's basically the revenue and expenses from the partnership, and then it gets divided up. So let's say Paula and I did form a business together and we were 50-50 partners. It would take 50% of all the information that happened in the partnership and put it on my tax return, and 50% would go on Paula's tax return. An LLC, some advantages, it's a separate entity from its owner. So it's it is something unto itself. So it is its own thing. There is no annual maintenance, so you don't have to file extra paperwork every year. There's a flexible management structure, and LLCs allow for the most flexibility in management structure. The liability is limited to the amount of the investment. So let's say that I wanted to build a pet hotel. Clearly I have dogs on the brain today, but let's say I wanted to build a pet hotel, and I put up $1 million for working capital and to build this really huge, we'll call it a pet chalet. So I build my pet chalet for $1 million. My liability, if I were an LLC, is limited to the $1 million. The disadvantages, I'm gonna skip that last one. It may be subject to self-employment tax. So remember that self-employment tax was that 8% that no one was taking out of my paycheck. So an LLC, and the reason that it says no LLC income tax form across the bottom for both an advantage and a disadvantage is because there is no separate tax form for an LLC. So LLCs can file, and we're going to cover this in detail too, but LLCs can either file as a sole proprietor, as a partnership, as an S-Corp, or as a C-Corp. So they kind of get their choice, which again is that flexibility in that management structure. So we'll talk about that in detail in a minute too. An S-Corp, personally, my business is an S-Corp. So its advantages, it's a separate entity from its owner. So it is its own thing. It has a continuous life. My liability is limited to my investment. So back to my pet chalet, my $1 million. I can sell all or a portion of my stock. I am not subject to self-employment tax. So I do not pay the 8% self-employment tax. The disadvantages, an annual filing is required. So every year with the Arizona Corporation Commission, I have to file a piece of paper with them, which is easy. You do it online, it costs $30, I think. There's a limit of 100 owners and you can own only certain types of owners. So for example, in S-Corps, you can have LLCs own shares of an S-Corp, and you can have people own shares of an S-Corp, and you can have some trusts own shares of an S-Corp, things like that. There is a separate tax return, so even though I'm a CPA, I do pay someone to file my tax return for me. And the shareholder must take reasonable compensation through payroll. So I am actually an employee of my own company as the owner. So, and this is a requirement that the shareholder must take reasonable compensation through payroll. What's reasonable is kind of a gray area with the IRS, and we'll talk about this in a minute too. But basically, like if you are an S-Corp, you take payroll instead of just taking the profits. The last business type we're going to cover is a C-Corp. Its advantages, it's a separate entity from its owner. It has a continuous life. The liability is limited to the investment. You can sell all or a portion of your stock, and you can have unlimited owners. So remember, in an S-Corp, you could only have 100 owners. So in a C-Corp, you can have unlimited owners. Disadvantages, there's an annual filing that's required, a separate tax return. And then corporations are subject to income tax, and dividends are subject to individual income tax. So basically, we'll discuss this at the end as well, but if you are a corporation, if you're a C-Corp, you pay a corporate level tax. So revenue minus expenses for a C-Corp, let's say you have $100,000 of revenue and $5,000 of expenses, $95,000 of profit. That $95,000 is taxed at that point. Then you pay dividends to your owners, and dividends are taxed at the personal income tax level. So this is what they call the double taxation of income, if you've heard that phrase before. Most entities that are traded on the stock exchange are C-Corps. Okay, so maintenance and commingling. To keep corporate filings, you need to keep all your corporate filings current with the Secretary of State, including updates to your addresses. So remember when we were talking about LLC and I said that there was no annual maintenance? If you move your business, you need to update the information on your LLC paperwork with the Corporation Commission in Arizona. Sometimes it's the Secretary of State if you do business in a different state. So you have to keep your information correct. And don't commingle your money. You keep separate bank accounts. So you pay your business bills with your business money, and you transfer money to your personal accounts to pay your personal bills. So, okay. I had a tax professor once that always said clear as mud. So, clear as mud? Any questions yet? Okay. So the next thing we're going to talk about is what is actually taxable business income. So generally, business income are the business inflows, which is revenue, minus the business outflow, which is expenses. So think of it this way. If I will use my sports chalet as an example, my dog, my pet chalet. So let's say it's December 30th and I decide that I'm going to start building this chalet, and I go to the bank and I open a business bank account and I deposit my $1 million. So that's clearly an inflow, but is that revenue? It's not. So any money that an owner puts in or an owner takes out is usually not revenue or expenses unless you're a C-Corp, which I would recommend that no one ever is. So outside of being a C-Corp, if I put $1 million into a bank account, into a business bank account, that is not revenue to the business. Similarly, if I take 100,000 back out, that's not an expense to the business as well. So on December 31st, or on December 30th, I go to the bank, I deposit my $1 million. I have zero taxable income for that year because my $1 million is not revenue. Okay? There are some limitations on certain things, like meals and entertainment are limited to 50% in most instances. And now there's special rules about meals and entertainment with the Tax Cuts and Jobs Act that was passed a couple years ago, which we'll talk about too. Travel is limited to business use only. So for example, currently I told you I'm in Oregon. So I came up here to be a bit of a snowbird this year. And I do have, my second largest client is here in Oregon. So when I'm up here, my tax accountant said that driving my car up here is deductible, but when I am here, I have to decide, like, you know, am I here for a business use or am I here for a personal use? And that's what we have to decide. So think about it this way, like if you have a conference in Hawaii and you go a week early and you stay for 2 weeks and the conference is only 1 week, only 50% of your travel costs would be deductible then. There's special rules for the business use of your personal vehicle, and there's no commuting miles. So for example, if like in the before times is what we're calling it. So before COVID, I would go to my clients' offices. So I had an office and then I would go to my clients' offices. So if I drove from my house to my office, that's considered a commuting mile and I don't get a deduction for it. If I drive from my house to a client's office, that's a business mile. And then there's certain limitations for your home office deduction. So if you have a home office, I would just suggest that you Google those rules. They're fairly easy to read, but it needs to be a separate designated space that's only used for business. So your dining room table doesn't necessarily count if you use it for meals and you pack everything up at the end of the day, for example. And then again, cash taken by an owner is not a business expense. Record keeping. So keep all the documents to verify your income, your purchases, your deductions, and your credits. So you want to keep them for a minimum of 3 years. If it is related at all to employment tax, you want to keep it for 4 years. If it's related to business property, you want to keep it for the life of the asset. So for example, if let's say that you own a company that hires, you buy a big piece of machinery, like a big, tractor, earth mover or something. If that asset lasts you for 20 years, you would keep that receipt for 20 years. And then this publication, 583, Starting a Business and Keeping Records, is an excellent resource from the IRS. They tend to write things sometimes in legalese, but mostly they do a really good job with the examples. So, all right, any questions? Okay. So someone asked if we can scan these documents and save the electronic file and throw the paper copy away. Yes, electronic receipts are totally allowable. So yes, you do not need to keep paper receipts. So I would just make sure that if you, to back up your electronic file, and you'll be all set. Okay, so business tax forms. So there's a question about using internet for their home office. Is it deductible? So I would say yes, you can. Yes, you can use. You should be able to deduct the use of your internet at home. However, I would caution you that if you use your internet for personal use, you should prorate it. So for example, my cell phone is the only phone that I have, okay? So I don't have a landline. At the end of the year, my tax accountant and I discuss how much of my cell phone I use for business versus personal. And let's say that I decide or have documentation that I use my cell phone 85% of the time for work, then I would deduct 85% of the cost of my cell phone. So I would do something similar with your internet. However, in the COVID times, I think that it's very reasonable to include an internet home office deduction as a business expense. Good questions. Okay, business tax forms. So you remember how we talked about the different types of entities? So a sole proprietor files a Schedule C form on their 1040 return. A partnership files a Form 1065, an S-CORP files a Form 1120-S, a C-Corp files an 1120-C, and an LLC can file a Schedule C, a Form 1065, a Form 1120-S, or a Form 1120-C. So reading this slide kind of makes me feel like a bingo caller, but at the same time, like these are all the different types of forms that are available, and you can see that flexibility that the LLC allows, because you have the option to decide how you want to be taxed as an LLC. When they first came out, and LLCs have only been around for maybe 25, 30 years, I think now. When they first came out, there was a lot of like rumors and scuttlebutt about that they're going to create an LLC tax form, and I'm pretty sure that that ship has sailed. So I don't expect them to create a special tax form for LLCs. So what happens when you file one of these types of returns? So a Schedule C, it's just adds on to your personal return. With a partnership and an S-Corp, and including LLCs that file as a partnership or an S-Corp, they're called flow-through entities. So basically what happens is any revenue or expenses that are generated in the business entity flow through to the personal return. So here, I'll just kind of read this little eye chart to you. So income generated in flow-through entities flow through to the owner's personal income tax return, their Form 1040. All except C-Corps are treated as flow-through entities. In flow-through entities, owners receive a K-1 reporting their business income that's generated from their businesses. A K-1 is similar to a giant W-2, is how I answer it, how I think of it. So this is an example of a K-1. And basically, when my business, my S-Corp, I report on my S-Corp tax return. Here's the revenue that I received from my clients. Here's all of my expenses, my payroll, my rent, you know, my part of my cell phone, my business miles, whatever. I put all of those expenses on there. And hopefully I come out with a profit at the end of the year. And then that taxable income then flows through and goes on my personal return. So on my 1040 return, it has a few lines down. It says, you know, business income from Form K-1. And so that box then, instead of having just a W-2 number, that's the box where I put any revenue or profit, taxable income from my business. Okay, so how business income ends up getting taxed. Self-employment tax, when you receive your paycheck, Medicare and Social Security are deducted on your paycheck. Your employer matches the Medicare and Social Security of each check. When you're self-employed, there's no employer that's matching your Medicare and Social Security. You pay this employer match of Medicare and Social Security on your personal tax return, and it's 7.65% of taxable business income. So this is where I was saying the 8%, I'm just rounding up to make it easier in our brains, but because you're not getting a W-2 paycheck, you could be subject to self-employment tax, which is 7.65% because there is no Medicare and Social Security. So in my S-Corp, remember that S-Corps are not subject to self-employment tax, but I have to take payroll. So as an employee, I get a paycheck and I have Medicare and Social Security coming out of my paycheck. And then as an employer, I get to match my own Medicare and Social Security. So I'm paying this 7.65% as an employee deducted from my payroll, and I'm paying it as an employer because I'm matching it for my employees. We'll talk about this more in a minute, and I have some examples at the end too. So self-employment tax applies to sole proprietors and partnerships and LLCs that file as a sole proprietor or a partnership. So if you're an LLC that files as a C-Corp or an S-Corp, it doesn't apply. So if there's a question, if there are partners in an LLC, how does the associated income flow through to the personal returns? So Michelle, they come through on the K-1. Basically, so let's say we'll go back to my pet chalet. So let's say Paul is my business partner in this. So what happens is if we're 50-50 partners, then half of the business income goes on my K-1 and half goes on Paula's K-1. And then it gets divided up from the K-1s. So basically the partnership return says, here's 100% of the income, and then it's gonna take it and split it out into however many partners there are. And absent an agreement otherwise, it's just gonna be, you know, divided by the number of partners there are. So it's either, and this would apply for a partnership or for an LLC that files as a multi-member LLC, an LLC that has more than one person in it. So, and the same thing with an S-Corp. If there's, let's say that in my firm, if there was another owner in my firm, they would also divide the business income through the K-1s. Okay. So basically, this little eye chart is since business income flows through to the owner, it's taxable at the owner's ordinary income tax rate. So how this works, and these are tax tables, and I'll just kind of run through this very quickly. If your taxable income, so this box is if you're single, the one on the top here, and if your taxable income is at least 100,000 but not over 160,725, you're basically in a 24% tax bracket at that point. So what you want to do is, and you can see that as you move up in income, your percentage that you pay gets higher. So the top rate is 37%, 35%, 32%, 24%. There's actually lower rates. There's rates below the 24%, but they basically add up to $5,800 in tax. So what you want to do is use these tables when you determine how much taxable income you think you're going to have from your business, and then come to these tables and figure it out. So here's there's a couple of other things that I want to mention here. So for example, I'm single, so whatever income I make from my business, revenue minus expenses, gets taxed at whatever rate it is. So if my taxable business income is $200,000, you're going to see I'm going to fall in this second line, right? So I'm going to owe $18,000 in income tax, okay? So if my taxable income from my business, revenue minus expenses, is $100,000, I'm going to fall in this first line, this $24,000. And let's say that I have a gangbuster year and my revenue minus expenses is $600,000. Wouldn't that be amazing? It would fall in this last line and it would be taxed at 37%, okay? So if I were, let's say that I start my pet chalet, and let's say I happen to be married to a brain surgeon, and my husband he has a salary of $500,000 a year. Okay, so he's going to get a W-2 for $500,000, and let's say my little pet chalet revenue minus expenses is $100,000. So now I have $100,000 from me and $500,000 from him. So we have $600,000 of taxable income. Okay, so since we're married, we would use this bottom box, and you can see $600,000 is this last line. So it would still be taxed at 37%. Okay, so you have to take into account, if you're married, you need to take into account how much taxable income your spouse is also like bringing to the tax return, I guess, or contributing to the relationship. So, and then you would add your revenue minus expenses from your business plus whatever W-2 or business earnings your spouse has, and then you would apply it to this table at the bottom. Okay, so that is kind of confusing, but let me know if you have any questions. And we'll walk through some examples also at the end. Okay. The Tax Cuts and Jobs Act. So this was passed a couple years ago. And basically what it did is it created this business income reduction. So the C-Corp rate was lowered to a flat 21%. So I just want to make sure, looking at this table, right, if my S-Corp made $500,000 and I'm single, I'm paying 37% tax, right? So wouldn't I, like, when this passed, everyone's like, oh, I'm just going to run out and become a C-Corp because C-Corps only have to pay 21% tax. And look, 21% isn't even on this chart, right? So wouldn't you want to be a C-Corp and only pay 21% tax instead of, up to 37%? So what happened is they created this business income tax reduction. So flow-through income could be taxed as high as 39.6% for single people. But what it did is the reduction is allowed for partnerships, sole proprietors, and S corporations. It's disallowed for specific service businesses with higher taxable income and phased out based on W-2 wages. We're going to talk about that in a minute. But basically what it does is it lowers the amount of income that's taxed. So if my revenue minus expenses is $100,000 for my S-Corp, then that $100,000, not only part of it gets taxed. I get to reduce it. So then I'm, in theory, paying 39% or 37% on a smaller amount of tax. So I'll answer your question in just a second. So the specified trader business, so remember that here it's disallowed for a specified service business with higher taxable income. So this is the list. So if your business is in health, law, accounting, actuarial sciences, performing arts, consulting, athletics, financial services, brokerage services, or any trader business where the principal asset of such trader business is the reputation or skill of one or more of its employees or owners, or performance of services that consist of investing and investment management, trading or dealing in securities, partnership interests, or commodities. So like in this list, so these things you have to examine. There's a phase out for businesses that are on this list. So you can see right here, my business is on this list. So if your business is on this list, this is the rough idea. So if you're in your household, you eat hot dogs, or in your household you eat steak, or you eat caviar, yes, you're going to qualify for the deduction. If you eat hot dogs, you might qualify if you eat steak. And if you eat caviar at your house, you're not going to qualify. So that's kind of how it works, is that it's phased out. So the higher, so if you think of it on a plane, the higher your taxable business income is, the less deduction you're going to get. Okay, so as your income goes up, your deduction goes down. So here are the phase outs. So any individual with taxable income over $157,500, or married couples with taxable income of over $315,000, that phase out starts to reduce. Okay, so if my revenue minus expenses for my S-Corp is $100,000, I get 100% of the phase. I get 100% of the deduction. If my revenue minus expenses is $160,000, then my reduction starts getting reduced. So I'm not allowed to claim as big of a reduction. Okay. There's a question about an LLC and how it and changing. Can an LLC change how it wants to file year to year? Can an LLC files a sole proprietorship 1 year and a C-Corp the next year? So yes, an LLC can change how it's taxed. I would not ever recommend changing it year over year, because there's certain tax implications that that can happen. So for example, though, most LLCs, when they start out, they'll end up being taxed as a sole proprietor. And then there comes a point where you want to make an S election. And I think we'll cover it. And if not, then I'll just pull up a whiteboard and show it to you at the end. But basically, there comes a point where it makes more sense to change your LLC into an S-Corp. And then at that point, you start taking a payroll check, a salary, and then you can, you actually end up saving some of the self-employment tax. So there's a way that that happens, and I'll explain it at the end. I'm gonna write myself a note. So if I can't, if I can't, I feel like it's at the end, but if it's not, then I'll answer it then. Okay, so this phase out happens at these two limits. And then meals, they changed meals and how they're taxed as well. So generally they're still deductible at 50% for the food and beverage expense. However, food at office parties is 100% deductible. Meals for clients are 50% deductible, but there's no deduction for entertainment. Employee travel meals are at 50%, and meals provided for the convenience of the employer are at 50% also, but not after 2025. So you want to have, if you have meals expense in your books and you have more than one type of these meals, you would want to create kind of subcategories. So you would have office parties, meals for clients, travel meals, meals for the employer, okay? Entertainment expenses are disallowed now. So any activity that's generally considered to be entertainment, amusement, or recreation is no longer deductible. Membership dues for any club organized for pleasure, business pleasure, recreation, or other social purposes are also disallowed. Any facility or portion thereof used in connection with any of these items is also disallowed. So there is no more deductions for entertainment. So you cannot, for example, like if you used to buy tickets to the theater and take clients, or to the Diamondbacks games, like there is no tax deduction for those anymore. The one thing that I thought was really curious when they passed this, and I'm still waiting to see if it'll end up in tax court, is like, how many of you have an Amazon Prime membership? Like, it literally is called a membership. So is now Amazon Prime no longer deductible? So I don't know. It's very curious, but we'll see what happens. Okay, questions? So basically what the Tax Act did was it reduced the amount of taxable income that flows through any of those types of entities. So basically, if you have taxable income for If you have $100,000 of taxable income that's going to flow through to a personal return, then you want to, it will be reduced by some percentage that your tax accountant will calculate or your return will calculate for you, and then only a portion of it will become taxable. Christian asked if it's the same for memberships to the Chamber of Commerce, and I would say yes. So like if it's called a membership due, then yes, because memberships, so those, and especially the Chamber of Commerce, I would think they would be organized for a business purpose. So, okay, how you calculate the tax. So I think it's 3 easy steps, but remember I've been doing this for 20 years and then they like, you know, pounded it into my brain in college. So basically the first step is your revenue minus expenses. So your revenue less expenses is the net income for your business and is a good estimate for your use of taxable business income. So basically like, yes, what we just talked about, maybe all of my meals are not deductible, maybe not, you know, my memberships into the Arizona Society of CPAs is not deductible, but roughly it's going to be okay. So like I use QuickBooks, which maybe some of you do as well. So I'm going to look at my profit and loss report of my revenue minus my expenses, and it's going to hopefully have a net number that's positive. And if that net number is positive, I'm going to take that net number and I'm going to go to those tax tables. Okay. So step 2 will be to take your business income estimate less the reduction. So remember there's that qualified business reduction, and less the itemized and standard deduction times the ordinary income tax rate. So all of these, there's a link at the end to find these numbers. But basically, so let's say my revenue minus expenses is $100,000. The standard deduction this year, I think, is $12,000. So then right there, so sorry, I missed a step there. So I'm going to reduce my $100,000 by the portion, by the qualified business income tax reduction, which is the part from the tax act, because we eat hot dogs in my house. So because we eat hot dogs, I'm going to qualify, and now my $100,000, let's say, will become $80,000 of taxable income. And then I deduct the $12,000 for being alive and a human being, which is the itemized or standard deductions. And so then now all of a sudden my 100,000 got reduced to 80,000. Now it goes down to 68,000. So what I would do is I would go back to those tax rates and make you all dizzy, zipping back here. I would go back to these tax rates and I would look to see where that number falls on this chart. And that's roughly the tax that I would owe. So in this example, like I'm under the $100,000, so I'm only going to owe $5,800. Okay. The one trick that you want to remember is that if you're subject to self-employment tax here, you're going to want to add in that 8%. So the 8% would apply to the $80,000. So automatically I'm going to owe a whole lot more tax than that $5,800. So self-employment tax always kind of seems to trip people up. So if you're a sole proprietor, you're going to owe self-employment tax. If you're an LLC that's taxed as a sole proprietor or a partnership, you're going to owe self-employment tax. If you're a partnership, you're going to owe self-employment tax. So make sure that you keep an eye on those if one of those instances applies to you. Okay. Also, I want to mention that if you are an LLC that files any of those entities, so if you're a sole proprietor, an LLC that files as a sole proprietor, an LLC that files as a partnership, or a partnership, none of you in any of those instances should ever take a W-2 paycheck. You should never have a paycheck, okay? So you need cash to pay your personal expenses. You just transfer it from your business account to your personal account, or you write yourself a check and you code it as a distribution or a draw on in your QuickBooks, but you never take a paycheck, okay? Although if you take a paycheck, you're going to end up paying self-employment tax 4 times. And I can go into more detail if you're curious about how that happens, but no payroll unless you're in a C-Corp or an S-Corp, okay? Or an LLC that files as a C-Corp or S-Corp. Okay, so how you pay the tax. So Donna, can you help me, please?
Sure. What do you-
So nothing, it just popped up that someone raised their hand. So,
Oh.
yeah. So Corey, do you want to, I can pause here if you want to type your question in the chat or in the Q&A. Sorry, not in the chat, but.
Yeah, I don't see, are you saying it's Corey? I don't see that.
Okay. All right, perfect. Well, Corey, if you still have a question, type it in the Q&A and then we'll.
Oh, there we go.
Oh, got it. Okay. Why not W-2 income? All right. Thanks, Donna. So basically, Corey, the reason that you don't want to, if you're a sole proprietor, a partnership, or an LLC that's a sole proprietor or partnership, if you're an employee and you take a W-2 wage from one of those types of entities, from a sole proprietor, for example, you're going to have Medicare and Social Security come out of your paycheck. You're going to match it as an employer, and that's going to happen automatically, like through the payroll company or through Intuit or whoever is processing the payroll. Then what's going to happen is when you go to file your taxes, you're going to pay the self-employment tax again. And the way that it works, you're not going to get credit for the Medicare and Social Security that you had come out of your paycheck. It's just going to be seen as an expense to the business. So you're going to end up paying it 4 times essentially. So, because when you pay self-employment tax on your tax return, it's actually you pay the employee portion plus the employer portion, and then you get a credit back for half of it. So, don't ever take a payroll like as a paycheck with withholding Medicare and Social Security coming out if you're a sole proprietor, a partnership, or an LLC that's taxed as a sole proprietor or partnership. So only do payroll. What type of, so Corey said interesting, he was advised to, or she, sorry, was advised to take a small salary of around $30,000 to $40,000 in W-2. So Corey, how are you taxed? Like, are you an LLC, sole proprietor, partnership? We'll wait for an LLC that's a sole proprietor. Yeah, so you should not be on payroll at all. So, and if you are on payroll, then get your payroll company to reverse it all and back it all out, because then you'll just get that money back. So if you should transfer money to your personal account and then pay all of the expenses from there. And there's an example at the end that we'll cover too, that will help kind of highlight those things. So, okay, so the estimated tax payments, so how you actually pay the tax. The method to pay the tax is when you have a job, the method that you use to pay your income taxes is the withholding from your paycheck, okay? So since there is no employer, you're gonna pay your own withholding. You're gonna include self-employment tax and your federal income tax. You're required to make estimated payments if you're gonna owe more than $1,000. And you can use Form 1040 ES to calculate how much it is, or you can just kind of use this little crazy formula here. And you make your estimated tax payments using EFTPS, which stands for Electronic Federal Tax Payment System. I love EFTPS. It's like wicked smart and super easy to make payroll tax, or to make your estimated withholding. You can use it, EFTPS, to make business like payroll tax payments, or you can use it to make your personal income tax. So someone has a question: if an LLC partner has payroll income with standard deductions from an employer outside the LLC, would the partner owe the 8% self-employment tax on any LLC profits? So I think I know what you're asking, but I'm just going to clarify. So if you're a partner in an LLC that is filing as a partnership, you would not be taking a paycheck. So you should not be on W-2. You should not have a W-2 from an LLC partnership. So you would owe the 8% self-employment tax on the LLC profits. If you had a job, let's say that you are a partner in an LLC and you also had a job, if your job has W-2 income, it's seen in a silo. So that W-2 income is completely separate from your LLC income, and that W-2 income would have Medicare and Social Security come out of it and not be subject to the self-employment tax. But any LLC income for a partnership would have self-employment tax on it. So let me know if that answered your question, okay? Underpayment penalties. So basically, remember I said that you have to, if you owe $1,000, you have to make payments, estimated payments. Generally, if you don't make the payments, you can be charged an underpayment penalties. So most taxpayers avoid this penalty if they either owe less than $1,000 or if they pay in 90% of the tax for the current year or 100% of the tax shown on the return for the prior year, whichever is smaller. So basically on the 1040 form, so for 2019, most tax returns will be filed, well, they're due by October 15th if you filed an extension. But let's say the tax on your tax return in 2019 was $4,800. You would have to pay, to avoid underpayment penalties, you would have to pay 100% of the $4,800 that you owed in 2018 into the IRS during 2020 to avoid an underpayment penalty. Okay, this is when the estimated payments are due. So notice that they're not all like, they're not all at the same time. So they're not 15 days after the end of the quarter. So for example, the first quarter payment, the first estimated payment is due April 15th. The second one is due June 15th, which is in the middle of second quarter. So there's 15 days left in second quarter there. The third payment is due September 15th, which is also 15 days before the end of third quarter. And the fourth quarter payment is due January 15th of the next year. Okay, so this is what EFTPS looks like. Excuse me, it's just EFTPS.com. You click on this little button to enroll here, and you just fill out the information. They actually snail mail you a PIN number that you use. You can add your bank accounts. You can schedule payments in advance. So for example, if your tax returns are done and you're doing the same or better this year than you did last year, you can go in and schedule, 1/4 of the $4,800, for example, on each of these days, and then it will just automatically suck out on those days. If there is a holiday, or one of these days falls on a weekend, the tax is due the next business day. And the question that I have now is, can you pay estimated tax payments off schedule? Does the IRS care? So you can pay the IRS more frequently if you would like. However, I would caution you that the IRS is not a savings program. So if you're only required to pay on these days, then I would pay on these days and I would put the money into a savings account. For example, like I have clients, and I don't know if you guys have heard of this Profit First, but I have clients that basically have, they'll get, let's say they get $1,000 from a customer of theirs, they'll automatically put 10% into this bank account for their taxes, and then they'll put 10% into this bank account for their profit, and then they'll have 80% left over to pay the bills with. So I think that is a better way to go, in my opinion, because I would rather hold on to the money myself in case something catastrophic should happen, than give it to the IRS and not be able to get it back until I file a tax return. So for example, like if you, let's say in the before times, so we'll just use this year for an example. So let's say that you made your estimated payment, let's say you made an estimated payment in January and you made one in February and you were about to make one in March, and then COVID hit and your business income came to a screeching halt. You're not going to be able to get that money back from the IRS until you file a tax return in early 2021. So that would be my motivation, to only pay what you're actually going to owe. So, but you should set it aside definitely, so that you have it when it comes time to pay it. Okay, so EFTPS, I talked about this because I think it's amazing. You can also use it to make your estimated payments for the state. Theirs is called AZ Taxes, and this is the same website that you would use to pay any TPT taxes or sales tax that you have in Arizona as well. Okay, some examples. Okay, so we're gonna make a couple of assumptions. Does anybody have any questions? Do we want to talk about anything else? It's so weird, you know, presenting and not having like hands and faces in front of me. So, okay, so we're gonna assume a taxpayer is single and the business is their only source of income, okay? So this is what happened to them in that year. They had revenue of $1,000. They paid $100 in rent, $5 in office supplies, $12 in utilities, $2 for a telephone, $8 for insurance, $6 for meals, for a net income of $867. I'm going to answer this next question in just a minute, okay? So if my revenue minus expenses is $867, then this would become the flow-through income to me, okay? So either and this is how we're going to compare it. Here's my sole proprietor column, here's my S-Corp column, here's my C-Corp column. So the reason that I didn't put the partnership on here is because the partnership would be the equivalent of the sole proprietor. It would be taxed the same way. And here it would just assume that we're just going to pretend that the $867 is that partner's share of those profits, okay? So the net income number is the same across for the sole proprietor, the S-Corp, or the C-Corp. Remember how I said that S-Corps had to take reasonable compensation? So this $560 maybe is the reasonable compensation. So that comes out of the S-Corp as payroll expense because this owner, the owner of an S-Corp, is part of the business, okay? So this $560 here is their business, their W-2 income from the S-Corp. Notice that there is no reasonable compensation for sole proprietors and C-Corps. That's not a thing, okay? And then payroll taxes. So remember we talked about if you're an employer and you have Medicare and Social Security coming out of your employees' paychecks, you have to match it as an employer. Oops. So this is the payroll taxes. So now there's a 20% reduction. And remember that reduction applies to sole proprietors and to S-Corps, but not to C-Corps because C-Corps are just taxed at 21%. So this 20% reduction here, the reason it's only $48 is because the net taxable income from the S-Corp changed. So the net income was $867, but they have $560 of owner payroll expense, and they have $67 of payroll tax expense, which leaves then less taxable income for the business. So 20% of it is only $48. The only way to get money out of a C-Corp is with dividends. So let's just pretend that our C-Corp pays a $500 dividend. So now we're left with the estimated business taxable income. And you can see here, they're all different numbers, right? They're all totally different amounts. So our sole proprietor had $867 of taxable income. 20% was $173. So that's the business income tax reduction. So they're left with taxable income of $694. So we're just going to assume they're in the 28% tax bracket. So that creates $194 worth of tax for them. They have to pay self-employment tax of $53. So they're going to pay $247 of total tax, okay? $194 plus the self-employment tax, $247 of taxes. So back to our S-Corp. We have the same $867. We subtract $560 for payroll expenses for the owners, W-2, $67 in payroll taxes. Their 20% flow-through credit is $48, which leaves taxable business income of $192. That personal income tax expense here is $211. So what's included in this number is 28%, because that's our tax rate, of $192 plus 28% of $560, because the owner is going to get a W-2 and a K-1. So their W-2, sorry, my crazy thing. So their W-2 income is $560, but they have K-1 income of $192 as well. So that creates $211 of personal income tax. Notice that there's no self-employment tax for our S-Corp. And the reason that there's no self-employment tax here is because it was paid here. It's payroll tax expense. So then our S-Corp owner would pay $265 worth of tax. So remember, we were talking about if there's a point where if you own an LLC that files as a sole proprietor, or you're a sole proprietor, that you might want to form an S-Corp or an LLC. This is why. Because at a certain point, this estimated self-employment tax is going to start climbing, because there's no limit on it either. So it's going to start climbing, and it's going to surpass the amount of payroll tax that you would have to spend. So there comes it's a kind of a balancing act about when you want to stop paying self-employment tax and start paying payroll tax expense. Okay, let me cover one more thing and then I'll answer some more questions. So the C-Corp, it's $867 of taxable income. We have $500 of dividend expense. So the estimated business taxable income is $367. So in this example, this $140 is 28% of $500. So if I own a C-Corp, I would take out dividends of $500, and those dividends are taxable to me personally as dividend income. So I would pay $148 of tax on $500 of dividends. My business, the C-Corp, would also pay a tax. So they would pay 21% of the $367 or $182. So you can see kind of in this, this is a very simplistic example, but you can see that how you're taxed really determines how much tax you pay, what type of entity you are. So I would never recommend that anyone is a C-Corp just because of that 21% tax that is on the business income. Okay, all right, so there's a couple questions. So the first one that I'm going to answer is, how is reasonable compensation determined? So it's not defined. So the reason they call it reasonable, and the way that it's worded and thought of from the IRS's perspective is, what would you have to pay someone else to do your job? So as a business owner, and I'm not sure I could pay someone else to do my job. And if I could, I'm not sure my business would have enough profits to pay someone that amount. My rule of thumb that I generally try to use is I try to keep a balance where my reasonable compensation is about 65% of whatever my net income is. So for example, I'm gonna back up here. So if these were my books for the year and I had $1,000 of revenue, all of these expenses, $867 left over, I would then say my reasonable compensation would be 65% of $867. So that's kind of the rule of thumb that I use. Some years it's more beneficial, for example, to increase that amount, like if you have extra cash in the business that you want to get out for that kind of thing. And then there's a question, would the savings, would that saving the profits or setting the profits aside be the same as retained earnings? So sort of. You're on the right track there, but basically how it works is if in a bubble, so in this example, what's going to happen, and it happens automatically in your QuickBooks, is this $867, if you were to run your balance sheet for the year, for example, that $867 would be in the net income line. And then if you move to the next period, so let's say that this happened in 2019, then this $867 would move from that net income line to the retained earning line on the balance sheet in your QuickBooks file. And the reason it does that is because it's, so yes, that's how it works, but basically like, there's other things that factor into retained earnings, so it's not all retained earnings. And then remember that paying income taxes, so all of these numbers here outside of this $182, none of these are deductible as business expenses. These are just the cost of being a citizen. So these are not business expenses and would never be deductible, and they should not be paid out of your business bank accounts. You need to transfer the money to your personal accounts and pay the tax from there, okay? And then Corey asked again if there's a specific amount of sole proprietor income you should have before you convert to an S-Corp. So first, sole proprietors cannot convert to an S-Corp, so you have to do a step in between. I just wanted to clarify the legal part there. You have to create an LLC that then elects to be taxed as an S-Corp, or you have to form a corporation and say that you're choosing to be an S-Corp. Okay, so you have to do that bit of paperwork with the Corporation Commission first. Then, yeah, so that threshold, Corey, depends on whatever else is going on your personal return as well as what's happening in your business. So remember my example earlier about being married to a brain surgeon? So there, it would probably, my threshold of having sole proprietor income versus S-Corp income would probably be different if I was married to a brain surgeon than if it's just me being single. The rule of thumb before was about if it's just you and it's just business income, there's no like rental properties or investment income or other W-2 income, then the rule of thumb was about $75,000 of taxable income. Because then once you hit 75,000 of taxable income, for example, you could take 50,000 as wages, and you would then pay payroll taxes on 50,000 instead of self-employment tax on 75,000. But with this new tax act, I feel like the rate's gone up because of the 25% business income tax reduction. So I would say it's probably closer to like 100,000, 110,000 now. And any tax accountant can run these comparisons for you. So if you are an LLC that files as a sole proprietor, you can make an election anytime during the current year for the next year to be taxed as an S-Corp. So let's say you're an LLC that files as a sole proprietor in 2020. So right now it's September, you can tell the IRS, hey, in 2021, I want to be taxed like an S-Corp. It's a one-page form, you fill it out, you send it in, eventually they'll answer, and then you'll be taxed as an S-Corp in 2021. You have until February 15th of that year to make the election for that year. So you have until February 15th of 2021 to tell the IRS that you want to be taxed as an S-Corp in 2021, okay? Or you can, if you formed your LLC this year, so let's say you were a sole proprietor up until now, and now like I've inspired you and you want to go form an LLC and make an S election, if you form your LLC now in 2020, you can still elect in 2020 to be taxed as an S-Corp for 2020. So if you made your LLC this year, you can elect to be taxed this year as however you choose. Okay. All right. Make sense? Okay. Here's some really super fun links. So this first one, if you click on this first one, it'll give you a comparison of all the different entity types that we talked about. So it'll show you like the advantages and disadvantages of an S-Corp, of a C-Corp, of an LLC, and a sole proprietor, and a partnership. This publication 583, this is the one that talks all about like record keeping and is pretty good about like things you should keep and how long you should keep them. This next one is all about self-employment tax. So if you're one of those entities that are subject to self-employment tax, go peruse this website as well. And then here's the EFTPS and AZ Taxes link. And there's another question, can reasonable compensation be paid at the end of every year, or does it have to be paid every month like we receive a salary? So no, you can pay it all out at the end of the year. The one thing I'm going to caution you on though is, so let's say for example, we'll just go back here. So let's say this is your business, this S-Corp, and it gets to be, December 15th and you haven't taken any payroll. And now all of a sudden you have to take $560. So one, that's going to get really expensive very quick because you're going to have to pay this $67 in tax plus the $67 that is the withholding amount from the paycheck that you're taking. So that portion is going to be expensive. Plus, if you have withholding, it's going to be expensive on top of that. And then if you're using a payroll company, most payroll companies will then try to force you to pay out the net pay, which in this example would be about $400. So you're going to pay $400 in net pay, $167 in employee taxes, $67 in employee taxes, and $67 in employer taxes. So then all of a sudden, what is reasonable compensation then gets really cash intensive right at the end of the year. So I would just say if you plan for it, you can do it. I tend to do things like that, but like, for example, how I do it in my firm is I have I pay twice a month and I pay myself like $1,250 twice a month. So like my salary each month is nothing, it's $2,500, but at least I have something. So then at the end of the year, and I'm not like having to pay out, $560 in this example at the end of the year. Okay, I want to just talk for a minute about the PPP and the EIDL. So first, everything around the PPP and the EIDL and the tax treatment for them has not been decided. So I just want to make sure that you're aware of that, especially the PPP. So the intent of Congress when they passed the Paycheck Protection Loan was that I'm going to back up even more. So if you have debt forgiven, so let's say that you owe, I don't know, $100,000 to someone. If they forgive that debt, it becomes taxable income to you, okay? It's always how it's been. Any debt forgiveness becomes taxable income. So when Congress passed the Paycheck Protection Loan and the CARES Act, their intent was that when the PPP was forgiven, it not become taxable income. However, the IRS's antiquated systems have no way to handle that because according to the IRS, is if you didn't earn the income, then it is not taxable. So remember my $1 million that I was going to put in my bank account for my pet chalet? Like I didn't earn that. That was just mine to start with. So it isn't taxable. But so right now, the way that it is at this very moment is the intent of Congress was to make the PPP forgiveness not taxable. However, the IRS has no mechanism in place to support that. And the way that it is now is the IRS is saying for expenses that you used, payroll expenses or rent or utilities or mortgage interest that you used with your PPP dollars, expenses that you paid with your PPP dollars are to be excluded from your revenue and expenses that you report to the IRS. So let's say I got a $50,000 PPP loan and I paid all my employees with it and I didn't pay anything else. Like let's say it was all just gross pay, okay? So the IRS is telling me then that I'm supposed to reduce the amount of payroll expense I put on my tax return by $50,000. So this is where it stands today at this very moment. So thank goodness most of us are not filing a tax return until next April. But so it gives Congress some time to sort it out with the IRS. The intent though, and the IRS realizes this, but Congress has to do something like legally to make that change happen, to make it so that the PPP will not be taxed and that the expenses will still be deductible to the business owner. Okay, because right now the IRS is saying if you used PPP money to pay for business expenses, don't put those on your tax return. Okay, so keep an eye on it. The other thing that you can do is we all have 3 members of Congress. So we have 1 member in the House and 2 members in the Senate. So call whoever your members of Congress are and tell them that you're a business owner or an entrepreneur and they need to sort this out and they need to do it sooner than later. Okay, so that would be my advice. Tell them to figure it out and move faster. So the EIDL loans. So the EIDL, the Economic Injury and Disaster Loans. So those are handled a little bit differently as well. So first, the EIDL loan, there was 2 parts to it. So part of it, if you had employee headcount, you got $1,000 for each employee up to $10,000. So that's a grant. So unfortunately, grants are taxable income to a business. So that $10,000 or up to $10,000 will be taxable to you. In your QuickBooks file, that bank deposit that you got for the $10,000, just create an other income account that says EIDL grant and put it way below the line. Okay, your tax accountant will know how to handle it. The second thing is if EIDL, the SBA was offering EIDL loans up to businesses up to $150,000. So if you also got an EIDL loan, it is a loan. It is not a grant. It's not like the PPP that's going to be forgiven. So it is truly a loan. So for the second portion of the EIDL, if you got up to the $149,000, that's a loan and it goes on your balance sheet. So, and when someone gives you a loan, that is not taxable income to the business because it's not earned income. Like you didn't earn it, you just applied for it and somebody gave it to you. So basically, I don't have a lot of great information. Well, I have a lot of hurry up and wait information about these, but the PPP loan, call your members of Congress, tell them to get on it and get it sorted out with the IRS so that like information is clear. But the intent of Congress is to have none of the PPP income, none of the PPP loan forgiveness taxed, and businesses could still deduct all of the expenses, even if they use PPP dollars to pay them. The EIDL grant is taxable. If you got an EIDL loan, that is not taxable because it's a loan. So when you repay it, it's not a business expense either. Okay, so that was a lot about PPP and EIDL. Do you guys have questions about that? Okay. There's a lot of forest fires up here in Oregon, and like the smoke is terrible today. So it's just like blowing all around and the air quality is terrible. So excuse me, but okay. All right, so my last slide. Here's my contact information. You guys are welcome to send me emails. You can stalk me on the LinkedIn's as well. But if you have questions or you think of something, these slides, I emailed them to Donna this morning, so they'll publish them or email them out to you or put them on their website. So Donna can clarify that for us, or Paula can. So, okay, so Corey, you can ask a million questions. So if you received a $10,000 advance and a PPP loan, does the PPP forgiveness amount get reduced by $10,000? So basically, so Corey, what they were saying is you would have, so what they were saying is you could refinance your EIDL loan with the PPP, and then the PPP would be forgiven. So yes, my understanding is that the PPP forgiveness would be reduced by the $10,000. And then Joshua was asking if I can do a quick comparison with $60,000 of sole proprietor income. So let me, yes. Okay. So we'll make this a little bit bigger. Okay. So if you have $60,000, oops, it's a nice large number there. If you have $60,000 of sole proprietor income, so you're gonna owe 7.65% for self-employment tax. And I'm gonna go back to my table, my tax table. Hold on, I gotta find it in my presentation here. Okay, so from this table, remember this? So this example is going to be a little hard because the $60,000 isn't quite on this because it starts at 100,000. So we're just going to assume that it's an 18% tax rate. So this is the self-employment. And then this is the income tax. So we're going to assume an 18% tax rate. So what's going to happen here is you're going to take your $60,000 and you're going to subtract your QBI, which is a qualified business income reduction. And we're just going to assume that it's 20%, which usually it would be. Okay. So we're going to subtract $12,000 for that. And then everybody gets the standard deduction, which we're just going to assume is $12,000. I don't remember quite what it is at this moment. So then we're going to end up with taxable income of $36,000. So you're going to owe 18% of $36,000, and you're also going to owe self-employment tax. So roughly 11 grand. So it's not like, this is a lot of assumptions. I think this 18% is too high. And I think the standard deduction for 12,000 is too low. So, but you get the kind of rough idea of how you do it. So it's a 20% reduction of the business income. So then the amount you're taxed on is only $48,000. And I truly think this 18% is probably closer to 10. So, all right, does that help answer that? Okay. So Josh asked in this example if it would show that you had made 36,000. No, it would show you made 60,000. So if you were sharing this, so if you were using your business tax return to borrow a loan for a house or something like that, it would show that your business income was $60,000. So yeah, it would show 60 grand for that. Okay, so then another question, if a newly formed LLC experiences a loss for the first year with expenses being more than revenue, can we deduct the net loss in the next year tax filing? Absolutely. So the rule used to be that you could carry it back 2 years and forward 20 years. So for example, if let's just say, so we'll say that this is year one. So in year two, our business, something changed and we lost $50,000. So what happens in year two is you actually could carry this $50,000 back and apply it to the $60,000 that you had last year. So these rules changed with the Tax Act, and so now you can only carry it forward. So next year, if we have $75,000 of taxable income, in year three, this $75,000, so this year we would pay nothing, right? This would be nothing. In year three, we would net these together and we would have taxable income of the $25,000. Oops. So yes, so you would carry your loss forward until you use it. If you dissolve a business, for example, and you're filing a final tax return, any unused portion more than likely will get deducted in that year, and then you would just get refunds back. Okay, so someone says, I rent a storage unit monthly for an online business I have. Can I deduct this as an expense? If so, how would it be categorized? Can I also store items in this unit if they're related to another business entity or for personal use? So generally, yes. Rent for a storage space to store business files or property would be deductible, allowable as a business expense, as a deduction. I wouldn't see why you couldn't. And hold on, I gotta find your question now. Okay, so it would be deductible. You could either you could put it in a rent expense category, or you could create a storage expense and put it there. If you store items related to another business, that's okay as well. If you store items personally and it's not just a casual, like, you know, I'm just going to put this here until I, you know, sell it at my next garage sale kind of thing. It's only going to be here for a week or so. If it's casual personal use, then I would say it's fine to deduct. But if you are using half of it, for example, for personal use, then I would only deduct the portion that's used for businesses. So I would only deduct 50% of it. So I wouldn't deduct the whole amount, just to be safe. So, okay, hopefully that helps too. Okay, so Josh asked about driving expenses, vehicle use, and how to track properly. So business use of vehicle is it can be kind of confusing. So what you want to do, for example, like the easiest way, personally, I find the easiest way to do it is to just deduct whatever the standard mileage rate is for my business miles. So, because you're allowed two ways to deduct expenses. The first is the standard mileage rate, where you just take your business miles times whatever the rate is, so like 55.5 cents or whatever it is. Or you can deduct the proportionate share of all of your vehicle expenses, including depreciation. So, for example, let's just say that we drive 10 miles to a client's office every day, okay? So we would have to figure out basically, like, these are our business miles, these are our personal miles. So let's say that we drive from our house to the grocery store. We went to the grocery store today, and then tomorrow we went to see our grandma. And then on Saturday, we went on a road trip, okay? So you would have to go in and you would have to say, like, okay, you would have to say my business miles were I'll do it this way. My business miles were 15% of my total costs. So this 15%, like either way, if you either deduct the standard mileage rate or the cost, the actual expenses for your vehicle, you're still going to have to track the miles. So there's about 1.5 million apps that will do it for you now. And remember that commuting miles don't count. So if you drive from your house to your office, or if you lease an office, or in that other example, if you go from your house, you know, to your storage unit, because your storage unit houses your inventory that you sell, like, I would say those would be commuting miles and not deductible. So if you're going to have to keep a mileage log regardless, and the easiest thing in my opinion is to just take, you know, 15%, you know, take your 30 miles times the standard mileage rate. Otherwise you would take 15% of all your costs. So it would be, if you bought a new truck, it's kind of a little bit different because it depends on what industry you're in and it depends on what you're doing, but there is, and if you have another vehicle that you use personally, So for example, like Joshua, if you own a landscaping company and that truck, you bought it for the business in the business's name, then you could deduct that truck just as a business asset and you would own it as a business asset. But if you also use it for personal use, then you're going to have to divide and apportion your expenses between what was for business versus what was for personal. So you would do this either way. You would have to track your mileage. And then once you start a certain method for a vehicle, you're not supposed to change it. So in that instance, I would talk to whoever's doing your taxes for the year and really look at what your business does, why you bought the truck, what you're doing with the truck, things like that. So me personally, I just do the standard mileage rate because it's way easier. At the end of the year, I take my Outlook calendar and I print it out and I write the number of miles on each day. So your mileage has to be documented somewhere. So okay, Corey's asking, are there any tax advantages to purchasing equipment in a separate entity, a separate LLC, for example, and leasing it to the primary LLC? So essentially, so yes, there can be tax advantages to this. However, for most small businesses, it is not something that I recommend, because remember when we talked about LLCs? Let me find it here. So remember when we talked about this slide, like there was no tax form for this, but if you're a partnership, for example, there's a separate tax form, right? I forgot I wasn't on the screen like that. There's a separate tax form for a partnership. So if in that example, if your equipment LLC has more than one owner, you're going to have to pay for a tax return for that LLC, just to lease yourself your own equipment. So there's reasons that people do stuff like that. I find that it just kind of complicates the issue. So I would say each situation is different. But like, for example, like I have a client that he makes really large machines that machine certain parts, right? So think of it as like giant metal cutters. So he builds these machines. And so the equipment that he uses, that he owns to build the machines, a lawyer had him create a separate company that buys all the equipment. But the problem is that as a sole proprietor, as a small business owner, like sometimes cash can be very tight. And the problem is that he might have cash in his operating entity that needs to be in his machine equipment entity. And then it's just the complication of getting everything back and forth. And then the client comes to me and he's like, what can we do? Like, I pay so much in accounting fees. I promise I'm not ripping him off, but basically, like, now we have to do the books for 5 separate companies because his lawyer created 5 separate companies. So I would say, remember that each business entity has to have its own sets of books and records and its own bank accounts. So if you're really look at why you would want to create a second LLC for owning equipment, and then determine if that's the best path forward. Like, what is it that you're getting by creating that second entity to own that equipment? And if it's truly a way to separate assets and a way to make sure, like if you're in a high risk industry, it makes sense that the assets that you use to make income are in a separate business. Absolutely, that makes sense. But not all the time does that make sense for everyone. So, and you should talk to your accountant, so talk to your tax accountant and your lawyers about it, and then really determine, because lawyers tend to sell risk, and because that's what they see, but then how many people are actually experiencing this problem, and what can you, because maybe there's another way that you can protect your liability in those assets. So yeah, so hopefully that helps some. I would say for most businesses, it wouldn't be my first choice. For some businesses, it absolutely makes sense. So, okay, so going back to my comment about having a separate bank account for each business, is the same true for credit cards? Should I have a separate credit card to make purchases for each business? So Maybe. You definitely need a separate bank account. So a separate credit card might be harder to come by because as small businesses, again, like sometimes getting credit, and especially times like this, is not always easy to do. So me personally, I have airline miles card that I like for an airline that I typically fly because I have a travel habit because I don't have children. So that credit card, I hold in my personal name, not in the business name. And so when I buy something for the business on my credit card, then I create an expense report, which there's 1.5 million templates out there for an expense report. I create an expense report and submit it to my business, and then my business reimburses me as a person. So I like to do it that way, just because then I get all the airline miles as well. And I do use the airline miles when I have to travel for work, so then I just don't have any costs for work flying either. But I would say if you want to, you can have a separate credit card for each business. You don't have to. And in that instance, if you have one for business A, but you use the credit card for business B, then you would just want to make sure that business B reimburses business A for those expenses. So create an expense report from the one company to the other company, okay? And then our business credit card cashback rebates taxable income. A business owns a credit card versus personally owning a credit card and being reimbursed. So yes, if you get cash back from a credit card, that is taxable income. So when I record it in a set of books, when there's cash back, I put it in as interest income. So yes, it would be taxable for those rebates. Just like if you use, so let's say that you, do y'all know about the Office Depot and the Staples rewards? How if you buy like toner or paper, they give you $10 or something. So if you use that $10, like I got an email from Office Depot the other day that said I had a $13 credit or, you know, like reward or something. If I buy $13 worth of office supplies because I didn't actually spend cash, then it's not deductible to me as a business expense. And so Michael, this goes with your question. If you use personal miles for a business trip, could you expense the value of that trip? So the answer would be no, because it didn't cost you any money. But like the $11, you know, 9/11 fee that they charge you, that would be deductible. Yes, because you would have to pay for that. So but personal miles, if you use miles for a business trip, it's not deductible. Let me give you another example about business miles. So I went to a conference in North Carolina 2 years ago, I think, in the summertime. And the conference was all day Monday. There was like a happy hour thing on Sunday night. And then the conference was all day Monday and all day Tuesday. And my brother, it was in Raleigh-Durham in North Carolina. And my brother lives in Wilmington on the coast. And I hadn't been out to see him in his new house yet. So it's about 2 hours from Raleigh-Durham. So according to the IRS, so I decided to go for a week. So I flew out on Sunday and I flew back the following Monday. So I was gone for 6 nights or 7 nights or whatever. So I was gone like 7 days. So what I did was, and I wanted to rent a car, right? Because I needed a car to get to and from the conference center each day. And clearly the hotel that I rented in Raleigh-Durham, in that city, was entirely deductible, right? Because I was just like, the conference ended, I checked out of the hotel and drove to my brother's house. And then because he's a nice brother, he let me stay there, right? So, but what I had done is when I rented the car, I put in the search parameters for the car that I was going to arrive on Sunday and return it on Tuesday night, right? Because in theory, I could still fly home on Tuesday night back to Phoenix. So I put in arriving on Sunday, flying back on Tuesday. I got to the price page and I took a screenshot of the price page. Then I actually rented the car from Sunday through the following Monday. And in that instance, I knew exactly how much was for business travel versus personal travel, because I had the screenshot of the quote for the same car from the same company for the 3 days that I would have rented it had I stayed in Raleigh-Durham and only gone out for the conference and not gone to see my brother for the rest of the time. So that was a really easy way for me to do it. I also used my airline miles, so I only deducted the $11.20 or whatever they charged me for the 9/11 fee. And in my opinion, because I had to go there and back, and that $11 would have been the same whether I went there on Sunday and came home Tuesday or went there on Sunday and came home the next week, it would have been the same. So I deducted 100% of that $11 too. So hopefully that makes it a little bit more clear about business expenses and mileage and business travel. So, okay, what dates are important to record for bookkeeping? For example, for the purchase of one item, I've had situations where there are a few dates. The actual date I made the purchase, a different date on my receipt or invoice, a different date on my bank or credit card statement, and the day I pay my credit card statement. So Donna, will you leave this one here for a minute? So there's a few things about this, and it depends. So first, I want to clarify, if it's a piece of equipment, okay, so let's say you're buying a big tractor or something. So if you bought the tractor today on September 10th, but you had to pay for it, but let's say it's in Tucson and you have to have it shipped up to Phoenix, and they're not going to be able to do that till Monday, that date is Monday, because you can't start, it's called a placed in service date. So for any kind of asset, any kind of piece of equipment or machinery, or like tenant improvements is an example. So like if you rent an office space and it's just a shell with, concrete floors and, the open exposed ceiling, and you hire a contractor to put up drywall and carpet and stuff, until you take the space over and the asset is placed in service, or is in a way or a state that you can actually start to use it, that's the date that you use for your asset, a placed in service date. So the day that you start to use the asset. So think about it like a printing press or something. So if you have it installed in the building, just because you bought it, but the electrician can't hook it up for another 3 weeks, you can't just start depreciating that asset until it's actually hooked up and you start to use it. So regular things, so regular purchases, office supplies, rent, things like that. Most businesses are cash basis taxpayers. So I'm going to preface this too, that I'm assuming that you are one of the 95% that are cash basis taxpayers. So the day that you spend the cash is the day that it is an expense to you, provided it is an expense that you're paying for. So if you go out today and you buy toner and you write a check to the office supply company, or you pay them cash at the register, your business expense would be today on 9/10. If you used your business credit card or your personal credit card, it might be slightly different. So with your business credit card, the expense is still today on 9/10. If you used a personal credit card and you reimburse yourself from the company, it would be the date you reimbursed it, okay? So there's a couple of nuances there. Sometimes if you can get a receipt from the store that will say today, but it will show up on your bank statement tomorrow, the date is today. It's the date that you bought it, provided you used some kind of business mode of payment. You used your business debit card, you wrote a check from your business account, you used your business credit card, okay? If you use a personal card, it's the date you reimburse yourself for. So that would be those things. There is a way that you can not reimburse yourself for those expenses and just say, I'm just contributing capital to the business. And if you want to know more about that, send me an email and I'll tell you how to do that, because it's a slightly longer conversation than we have time for today. So in those examples, again, if you go out and buy a bunch of stuff on December 31st and they all clear the bank on January 1st, the business expense is December 31st, because that's the date that you made the purchase, not the date that it clears your bank, okay? Because you can write a check to someone today that they don't cash until next January, but it's still a business expense this year. And I want to warn you all that when you use QuickBooks Online, it's going to be the date that it cleared the bank, not the date that you bought the purchase. So at the end of the year, it doesn't so much matter during the year, but in January, when you're sitting down in front of your QuickBooks Online and you're going through all of your bank feeds, you're going to want to make sure that if there's something that's on that list that's dated January 2nd, for example, that you know that you bought in 2020, you need to go in and edit that date in the transaction. So, okay, hopefully that answers that about the dates. Okay, is inventory an expense? For example, if I bought a lot of items and sold a few of the items for profit and donated the rest, can I write off the initial purchase and the donated portion? So inventory is kind of goofy. So if you hold inventory, so if you buy products that you intend to resell, the only portion that is an expense are the ones that you sold. So if you, we'll just do a quick example here. Okay, so let's just say that this is our inventory. So we have 3 parts in inventory and we sell one of them. Let's say we sell part 1. So we're going to take it out of inventory. And I'm just going to apologize in advance. My dog just woke up from her nap and is looking at me with crazy eyes. So she's about to get real weird here. So when we go buy our initial inventory and we spend $30 on our inventory, this is not an expense to us because we haven't sold it. Once you sell it, then it becomes an expense. So this $10 is our expense. However, if you, so now like what we have left in inventory is just this $10, these 2 parts for part 2 and part 3. If you donate part 2 and part 3, then you don't have them in inventory anymore, and we can't have an ending balance of $20 here. So then you are correct that you would get a $20 like charitable donation deduction for whatever the cost of those inventory items were. So I want to caution you there too. There's absolutely, if you donate something from a business, it is a business expense. So if you buy, let's say you buy the wrong, I don't know, let's say you go out and you buy a whole bunch of paper and it happens to be green or something instead of white, and you give that box of paper to a school. So instead of deducting that cost of the paper as a business expense, you would deduct it as a charitable donation. And if you deduct it as a charitable donation, sometimes it's disallowed for the business, but it goes on your personal return. So I'm an S-Corp, so if I give $100 to a charity, for example, I can put it in my books, in my QuickBooks as a charitable donation, but it doesn't show up on my revenue minus expenses on my business tax return. It shows up on my K-1, and then it goes on to my Schedule A on my personal return as a charitable donation. Because as an S-Corp, like the money that my business gives is the same as it's considered me individually giving the money. So it just gets kind of handled weird, oddly, on the tax return, but you still get the same deduction for it. So yes, you can give inventory away for the donated portion. Yeah, so Joshua, if you're like one of those people like on Storage Wars, it kind of sounds like, so he's saying is an eBay reseller and storage units is where I source my merchandise. So if you're paying for a storage unit and you went in at an auction, then you would have to basically like figure out what portion of it, like let's say that you bid on eBay and it was $3,000 that you paid, then you would have to divide up that $3,000 between all the things that were in there and figure out how much was for each particular thing that you bought. Okay, so Corey asked, if you're leasing space and you do any construction, is there a specific dollar amount where it should be depreciated versus expense? For example, you add electrical outlets for $1,000. Corey, in the Tax Cuts and Jobs Act, they changed a lot of depreciation rules. So basically the limit now is $2,500 is where you want to start with a new asset. So if you spent $1,000 on new electrical outlets for your building, I would just expense it as repairs and maintenance on your lease space. If you spent $10,000 putting up walls and lights and carpet and a ceiling and all of that kind of stuff, a new HVAC system, then yes, that would become an asset that you would then depreciate. But the depreciation rules changed. So mostly if you were to spend $10,000 on an office space or on a piece of equipment, you should be able to depreciate most of the $10,000 in this year. And then Joshua asked if there's a limit to charitable donations. There is a limit, and it's basically 50%. I think it's 50% of your taxable income of whatever that is. So, okay. You guys are asking like good questions. So
Tanya, we have just a few minutes left of our session today, so maybe just 1 or 2 questions tops, and we'll kind of wrap things up.
Yep, that's what I was thinking too. So, okay. So anybody have any other pressing questions they want to ask? And I'll put my email back up here for a minute. So, okay, Josh asked, for example, I bought an auction for $2,000 and sold a few items and made $4,000, donated the rest for $1,000. Can I write off the auction and the donation? So you can't double dip, Josh. So the only thing that you, in total, out of everything there, because you spent $2,000 to buy everything, the most you could write off either as cost of goods sold or like inventory deductions or donations would be $2,000. So it's that would be the max, because technically that's all you had in inventory. So, good question.
Okay.
All right. And here's Paula to tell you some more.
All right, and then if you would stop sharing, Tanya, I'll go ahead and just put up a final screen here. And actually, I think I can do that. Okay. All right. Very good. Well, thank you so much, Tanya, for sharing this information. There's lots of questions, obviously, but hopefully it helped everyone kind of get some clarity around the business tax and income topic. So just again, if you're interested in SBDC counseling, just go to our main webpage. You see the link there, and just follow the link to request counseling. We'd love to hear from you and sit down and help you with your business. I would also encourage you all to follow us on our social media as we have new programs come up, such as this. That'll keep you kind of in the know for what we're offering as far as training programs and other just updates on different types of information, such as the PPP loans, EIDL loans, those kinds of things. We are going to post this recording up on our Maricopa website. If you go to the COVID tab, you'll find the recording in that area on our website. And once again, thanks, Tanya, for your time today. Really appreciate it. And thank you, everyone, for attending.